Welcome back to the Coastal Lowcountry Real Estate Channel. Are you looking to move to the Georgia, South Carolina Lowcountry and are not quite fortunate enough to pay cash for your next property? So you follow the advice of your real estate agent and you get pre-approved by your favorite lender. Unfortunately, the lender provides you with a bunch of paperwork and you are at a real loss to make heads or tails of it all. Or worse yet, the lender provides you with very little information and you have no idea what you're getting yourself into. Well, today we're going to try to peel away the confusion and provide you with information and tools to help you find the best mortgage product out there for your next home purchase. We like to say that you marry the home, but date the rate, meaning that you can often refinance your mortgage if the terms improve while you own your home. But even if you are just dating the rate, we want to make sure this is more than just a blind date and that you understand what information you need to make a good decision and how to sift through that information once you get it. So let's get started by looking at some of the basic information your lender should provide you whenever you get pre-approved for a mortgage.
Welcome to the Georgia, South Carolina Lowcountry. We're Keith and Donna Hellman, hosts of the Coastal Lowcountry Real Estate Channel and local realtors with Keller Williams. Do you want to know everything there is to know about living in the Lowcountry? Whether it's Savannah, Georgia, Hilton Head, South Carolina, Bluffton, South Carolina, or the surrounding areas? Well then subscribe below and tap the bell for notifications so that you'll be the first to know what's going on in our market.
And we receive calls, emails, and texts every day from folks just like you looking to move to Hilton Head, Bluffton, and Savannah areas. And we absolutely love serving you.
So whether you're looking to move in the next week, the next month, or the next year, shoot us a text, send us an email, give us a call, or schedule a Zoom call, all in the description below so that we can help make your move to the Lowcountry a smooth one. Hey, Let's get started.
Okay, so today we're kind of going to get into the weeds a little bit. I do numbers. My background was an accountant before becoming a real estate agent. So I'm going to try to explain in basic terms some of this information that you get from your lender. So every time we have a buyer that wants to go buy a house, we ask them to get a quote from the lender, get them pre-approved. And when they do get pre-approved, they should get an initial fees worksheet. It's a cost estimate of all the fees that you'll pay when you go to closing, as well as an estimate of what your monthly mortgage payment is going to be and things like that. What you have in front of you is an example of what that cost estimate should look like. So at the top of the page, you'll have the basic terms of the loan. This is a conventional loan with PMI, private mortgage insurance. The interest rate at that time was 3.75%, which obviously was a few years ago, which we don't have that anymore. Purchase price was of the house was $337,000 and they were borrowing $321,000. It's a 30-year fixed. They will escrow their taxes and insurance in their monthly payments. That means part of your monthly payment will go towards paying your insurance as well as your property taxes. Okay. The APR is an interest rate that's separate from this interest rate up here and factors in some of these costs. Okay. So this is generally something to consider or use to compare loans across the board. Going down to the closing costs. Okay. This is an estimate of closing costs that you should receive from the lender and you should see these on your closing statement. So in this instance, you can see where the lender has waived the loan origination fee. That generally can be up to 1% of the value of the mortgage. So $300,000 mortgage, you're looking at a $3,000 loan origination fee. Well, they've waived that. Processing fees, underwriting fees, and then you have a variety of other fees down here. The appraisal, various taxes, you've got owner's title insurance, lender's title insurance, things like that. And then sometimes a lender will give you a credit. So this particular lender gave a $1,000 credit. So your total closing costs amounted to $3,800. Then you get into prepaids and escrows, okay? Daily interest on prepaids is the interest that you're going to pay from the time you close till when your first payment is due, okay? So depending on how many days that is, you'll have that estimated. Homeowners insurance, generally the lender will ask you to go ahead and pay for 1 year's homeowners insurance. So you'll see that here, $1,900. Then we're going to set up your escrow account. Okay, so your escrow account is going to consist of the monies that are put into this account that the lender is going to pay your homeowner's insurance and your property taxes out of. And this all depends on when you close, okay, and when your insurance is due. But in this instance, the lender has opted to escrow 3 months worth of homeowner's insurance and 2 months worth of property taxes. So the escrow account is going to be almost $3,700, okay, just to get you started. Each month you're going to make a payment and that escrow account will grow. And then when the bill comes due, the lender will pay for your homeowner's insurance or property taxes out of that. Summary down here at the bottom, purchase price is $337,000, less the closing costs that you saw above. Add the closing costs, which you saw above at $3,800. Prepaids and escrows of almost $3,700. Then you have your down payment. $3,375 was the down payment. And in this instance, the seller offered to give $3,500 towards closing costs. So that's reduced here. Mortgage amount of $320,000. The net is what you go to closing with. So at closing, this particular buyer had to bring $17,500 to closing. That, again, is an estimate. It shouldn't vary wildly when you go to closing, but that will get you started, and you should get this right off the bat so you can compare this lender's loan to the next lender that you get a quote on. You should also receive a payment summary. So again, you have the general terms of the loan up top. Then you have your estimated monthly mortgage payment. This is almost $2,500. Principal and interest, as you can see, is almost $1,500. Hazard insurance, this is escrowed at $160 a month. Real estate taxes is $700 a month. Mortgage insurance, this is your PMI. In this particular instance, on a conventional loan, if you pay less than 20% down, you're going to have to incur mortgage insurance. So that's $107. That's a fee that the government charges for paying less than 20% down on the purchase of your home. Then this particular property was in an HOA, so they are putting $38 a month towards HOA dues each month. And then when the bill comes due, that amount will be paid by the lender out of the escrow account. So total monthly payment is almost $2,500, okay? And you can see you got $1,500 here of principal and interest, almost $1,000 worth of taxes and insurance and various other fees that you pay each month to come up with your total of $2,500. So having this information from each lender that you get a quote from allows you to compare these loans side by side and see which is the best loan for you. Okay, hopefully your eyes didn't glaze over too much during that last little discussion. So now we're going to take this information, and in this particular instance, we had a buyer who was looking at a VA loan, and they got quotes from 5 different lenders. Actually, it was 4, and one gave them an analysis of 2 different loan types. As you can see at the top of the page here, we've dropped them into this spreadsheet. We got lender 1. We also had a builder who had its own lending company, and they provided lending assistance as well. Had lender 2, and then this is lenders 3, which gave us an analysis on a VA loan and a USDA loan. VA loans are 100% financing, so is a USDA loan. So we wanted to see, if maybe a USDA loan would be better than the VA. So that's the type of analysis we were doing here. So we start off with the sales price, almost $305,000. And then we come down here to the interest rate. Now I'll explain the percent financed up here in a second. But we come down to the interest rate, and you can see the various interest rates that were provided. So everywhere from 6.25% all the way up to 7.25%. Okay, that's going to impact your monthly mortgage payment. So for example, down here on line 10, you can see the difference in the mortgage payments. So anywhere from $1,940 to $2,080, okay, depending on the interest rate. You can see how that varies. Mortgage amount. Okay, this is where you can kind of get into the analysis. So in a VA loan or a USDA loan, some of the fees get financed into the mortgage balance of the house. So even though the buyer was buying a house for $305,000, their mortgage was $315,000, which means $10,000 was included in the mortgage. So in essence, they had 103% financed of the price of the home. So that is where the percent financed comes into play. Now, when you're looking at loans across the board like this will help you when you start dropping these fees into these spreadsheets, and we can do that. We've done that for many of our buyers. You kind of are able to get an idea as to, whether all the fees are included. For example, VA loans always have a funding fee. So lender 3, you can see here where the mortgage amount was equal to the purchase amount, they are missing the financed fees for the VA loan. Lender 1, builder lender, and lender 2 did have finance fees that were built into the mortgage amount. But lender 3 was different. And actually, because this is a VA loan, this amount should be consistent across all loans. So something is going on here with lender 2, and it deserves an explanation from lender 2. Lender 3 USDA loan has $3,000 being financed into the mortgage. And USDA has a fee, but it is not the same as the VA loan, so may or may not be less. Next, you drop into your down payment. In purchasing this house, this buyer has said they're going to put $3,000 down. Okay, this also, I've seen where this has happened before, where you get a cost estimate from a lender and they don't include the down payment amount. It helps to have these things side by side so that you can see which is the best deal. All those fees that we talked about in our previous discussion are included in here. Some of them are highlighted, some of them are just grouped in miscellaneous other fees. Okay, so loan origination fees. Nobody is going to charge a loan origination fee out of these 4 lenders. Interest rate discount. Okay, this is what's just called buying down the interest rate. So loan 1, you're going to be paying $6,000, $6,300 towards buying down the interest rate. That drops it down to 6.5%. Lender 2, you're paying $3,000 towards interest rate discount. And so you can see how in certain instances, paying this additional interest rate discount would drop your interest rate for that particular lender. Loan 2 is the builder, as we mentioned before. And then we also have the estimated prepaid and escrows. So we talked about that in our previous discussion. So this is what they are putting in the escrow account to get you started off. So you can see, depending on the lender, some may require more, some may require less. So as far as property taxes, for example, loan 4 over here, they may be requiring 4 months worth of property taxes, whereas loan 3 might require 2 or 3 months worth of property taxes escrowed. So that's kind of some of the things you look for. The appraisal amount is another one I like to look at. It should be pretty consistent across the board. You can see here, first 2 lenders have $800 appraisal amounts. Then you get down here to lender 4 and 5. It's only $550. These should be consistent. If they're not, it might be worth a call to the lender saying why. Let's get down to the lender title insurance and the owner's title insurance. Now, title insurance is something that the lender requires in the event there's something wrong with the title, as long as the lender has a mortgage on the property. So you take out a 30-year mortgage, you pay over the 30 years. If anything goes wrong with the title, the lender will get paid off whatever the balance is on the mortgage at that time. Owner's title insurance is also something that we like to recommend our buyers get. Owner's title insurance pays if ever anything wrong with the title during the time you own the house. After you pay off the mortgage, if you're still living in that house, something comes up and somebody's great-great-great-grandfather once owned that property and they can prove it, next thing you know, you're out of a house. Owner's title insurance will make you whole. So I think it's a cheap insurance policy. As you can see, it ranges anywhere from $600 on up to $1,200. But it is a good insurance policy to have in place over the life of owning that house if there is a problem with the title insurance. Miscellaneous others fees, as you can tell here, they're kind of all across the board and it depends on the loan. So the USDA loan over here was almost $4,000 in miscellaneous fees. It might be worth taking a look at those, okay? Total closing costs. This tells you, kind of like from that analysis that we just did a little bit ago, this tells you what your total closing costs are going into closing. Okay, so here we have anywhere from $9,600 on up to $14,000. Okay, so total out of pocket before credits. This is going to be your total out of pocket, how much money you have to bring to the table before any credits that the sellers give or the lenders give. This also, has already taken out the down payment that you put in. As you saw up above, it was $3,000 that they were putting in. And you can see the difference between the total closing costs and the total out of pocket before credits. Difference here is the $3,000 that they put down. Getting into the lender credits and seller's credit. Now, this particular instance in the seller's credits, this particular builder lender had an $8,000 credit that they were giving towards closing costs to this particular buyer. So if you look up here where it says total out of pocket before credits, you might look at this analysis and you might say, okay, loan 4 looks like it is the best deal. I only have to come out of pocket $6,600. But then you get down here to seller's credit, this $8,000 you can see makes for a great swing in the difference between what they're saying the total out of pockets before credits is and after they give you the credit. So lender 2, you only had $459 you had to come out of pocket. Whereas lender 1, you had $11,000. And all of a sudden down here, lender 4, that doesn't look as appealing because they're only offering a $1,000 credit. So this is the type of analysis you need to look at. And after you look at all this, it might be obvious that, okay, we need to go with lender 2 because I'm only out of pocket $459. And you also need to look at the interest rate. Interest rate is 6.25. Not only are you out of pocket less money, but you also have an interest rate that's less than any other lenders. So overall, you make this analysis, and this helps you decide what is the best lender for your mortgage. I hope that makes sense. I hope we didn't get into the weeds too much. But this is the type of analysis you should do or have your lender or real estate agent walk you through so that you can pick the best product for your home. This is also why you want to get multiple quotes. So I hope I didn't lose too many people, or I hope your eyes didn't glaze over too much. If you have any questions or comments, don't hesitate to reach out to us. We'd be happy to help you through this.
Thank you for staying till the end of the video, and we hope this has been helpful and perhaps you now better understand how to evaluate the next best mortgage product prior to closing on your new home. And of course, we would be happy to help you evaluate your options, as well as help you find your new home in the coastal Lowcountry area. So if you need help selling or finding your new home, give us a call, shoot us a text, send us an email, or book a Zoom call, all in the description below. And if you want to stay up to date on the latest of what's going on in Georgia, South Carolina Lowcountry, please be sure to like, subscribe, and tap the bell for notifications so you'll be first to know about the current market here. Again, this is Keith and Donna Hellman, hosts of the Coastal Lowcountry Real Estate Channel and Local Realtors. And as always, it has been an absolute pleasure spending time again with you today.